So there seems to be, and has been for a while, a lot of confusion around what strategy actually does. And so I thought it would be a good idea to unpack the strategy business model in one simple short video, and one that I'll be using as reference when explaining to people how strategy works. So without further ado, let's jump in. So essentially, strategy's business model is to capture the spread between the cost of raising capital and Bitcoin's average rate of return. Now, in order to raise capital, strategy issues digital credit products, which are credit instruments backed by Bitcoin, that are deliberately engineered to appeal to different sets of investors. Now, this is important because different investors are optimizing for different outcomes based on their volatility, risk, and return goals. So, in this sense, strategy functions as a digital refinery. The same way that Standard Oil refined crude oil by converting it into products that were tailored to the needs of different consumers, strategy is refining Bitcoin by converting it into products that are tailored to the needs of different investors. So, for example, those who want short duration, high yield, predictable income, and minimum volatility and downside protection will buy Stretch. Those that want long duration, high yield, predictable income, and downside protection will buy Strife. Those who want long duration, maximum yield with less protections will buy Stride. Those who want a mix of moderate yield, predictable income, and Bitcoin upside and are comfortable with high volatility will buy Strike. And those who want maximum returns and are comfortable with maximum volatility will buy the common stock. So the more products that strategy creates, the more investors and by extension capital it can attract. Strategy then takes that capital that they raise and buys Bitcoin, which generates Bitcoin yield for equity holders and increases Bitcoin per share. And so the more Bitcoin that strategy acquires, the stronger its balance sheet becomes, the stronger its credit rating, and the more capital it will then attract to then go and buy even more Bitcoin, creating a reflexive flywheel. Now, I said to you at the beginning that strategy's business model is to capture the spread between the cost of raising capital and Bitcoin's average rate of return. And so the cost of capital is the yield that it pays out on its digital credit instruments, which ranges between 8 to 12%. Now, the yield is paid in fiat, which is depreciating at roughly 8% a year, which is the rate of debasement. Now, the asset that strategy accumulates is Bitcoin, which is appreciating at roughly 20 to 30% a year. And so, as long as Bitcoin's average rate of return does exceed the cost of capital, then the business model will succeed. If Bitcoin's average rate of return doesn't exceed the cost of capital, then the business model will fail. And this is why we say that the success of strategy will be determined by the success of Bitcoin. Strategy will live or die based on Bitcoin. So that's the strategy business model. It is extremely simple when you strip it down, but as we know, humans like to complicate things. So it's no surprise that we are seeing so much FUD. But as I like to say, the market's ignorance is your opportunity. Hopefully you found this helpful. Hopefully now you have a more clear understanding of how strategy operates. As always, until next time, remember the best is yet to come.